We're going to be talking this morning to kick things off about retail media. Now, I don't know about the rest of you, but I'm very aware, very used to seeing ads in my social network, my social media feed. I'm used to seeing ads on my news sites and most of my regular websites. But increasingly, we're seeing ads coming up all over the place on e-commerce sites. Retailers seem to be noticing that they can take advantage and monetize their websites. So what's going on here? Is this just a change caused by the pandemic? Are we heading for a post-pandemic hangover? Or is retail media party just getting going? To give us the answers to these questions, it's a great privilege to start this morning with the Chief Economist for IAB Europe, Mr. Daniel Knapp. Daniel, welcome.
Thank you very much. Good morning, and thank you for the kind introduction. So, my name is Daniel Knapp, and I'm an analyst. So, I crunch numbers and statistics about digital advertising to really understand where this sector is heading. And during the pandemic, it was peculiar that we saw not only cyclical changes based on how the economy is going, but also kind of broader structural change and the composition of digital advertising, spurred by the deprecation of third-party cookies and other things. And we saw this explosion of so-called retail media networks, i.e. advertising on the pages of retailers, typically for products that they sell themselves, and they're also using their own data to advertise those products elsewhere on the web. And I really want to talk about what's happening here, because I think this is more than just a new channel. It actually signals a massive structural change in how digital advertising operates. And is this just, as we heard, a quick kind of, was this just a pandemic boom and then we're now facing the hangover, or is there something more to it? Well, let's take a step back in history, and a very long step. This is the Roman calendar, from the year 46 before Christ. This was also called the Annus Confusionis, the year of confusion, because it was the year when the Roman calendar was switched to the modern calendar. And that took a long time, and it was the longest year in history ever of 445 days. I think we, in digital advertising today, are also facing our very own longest year. We got massive macroeconomic headwinds, but we also don't know how the foundation of our industry is going to shape up with new targeting paradigms coming, new ID solutions, etc. And it's really about trying to navigate this longest year in digital advertising, this year zero in a sense, and see what we can make of it. And I think there are two factors which shape this. Is this really now about more digital? We saw massive growth in digital advertising in 2021, 30.5% growth in Europe. But can this continue, or are we facing a digital hangover? Well, it's not looking too good. Here's a wonderful picture of the complexity of the global situation by the economic historian Adam Tooze, and he uses the German word Krisenbilder, or crisis pictures, to really reveal we don't have any old economic crisis, we have a polycrisis, meaning many different crises coming together and potentially, like an avalanche, self-reinforcing each other. And also we have, as you can see here on red, so-called macroscopic events, meaning if any of those things would happen, all bets are off, and the economy would take a massive plunge, and that wouldn't be the worst of our problems. And indeed, for advertising, it's bad news. The era of cheap money is over. Look at the chart on the left, which is one of my favorite charts as an analyst. What you can see here is a 5,000-year history of interest rates. How much did it cost to borrow money in history? And we can see, even for the ancient Egyptians, it was more expensive to borrow money than it was for us until the end of 2021. And it was often this cheap venture capital money that fueled new direct-to-consumer businesses, e-commerce scale-ups, and so forth. And these companies, they had to grow at all costs. So a lot of that money, that VC money, was pumped into marketing. That party now is over. And we can clearly see this on the right here, which is a counter, which says how many countries, how many central banks have actually raised interest rates. And we can see it's a historical first. Nowhere since the 1970s have we seen such a consensus among central banks to increase interest rates. So the era of cheap money is definitely over, which takes out some oxygen of digital ad growth. And also, we know that the backbone of digital advertising is small and medium-sized enterprises, and they have reached natural spending limits. On the very left, you can see the proportion of overall ads that go into digital from Fortune 500 companies, from the big brand advertisers in Europe. Around 40% of the budget goes to digital. For small and medium-sized companies, it's 72%. And they heavily rely on search, on social platforms and so forth, so 74% of their money actually goes there. But there are now natural spending limits with Apple ATT, with these companies not being able to attract and grow their customer base after 2 years in the pandemic when they were really digitizing. So this is also putting a damper on digital ads. And you know what? The world hasn't entirely changed. We haven't all become digital. What I did here is I tried to kind of map the quintessential pandemic stock, Zoom, our lifeblood for 2 years, over the passenger numbers of Europe's busiest airport. And we all know correlation isn't causation. But there's something very interesting in here. We can, of course, see that the world has become more physical again. And that, of course, means less time spent online, less time to monetize eyeballs, less oxygen for digital ad growth overall. And have we made this massive e-commerce revolution? Many said, yes, we made this leap, 4 years of innovation in 3 months. We're now in a new e-commerce paradigm. Well, we see something called regression to the mean, meaning after a period of exponential growth, we're falling back to the previous pattern of linear growth. This is data from the UK, from the Office of National Statistics, and you can clearly see how e-commerce growth with some seasonal blips was growing in a fairly linear way, quite healthily. We saw this massive explosion during the pandemic, but that has been shaved off now as people go back into physical stores. So we now have a very strong e-commerce infrastructure of payment solutions, of social platforms, social commerce, as was mentioned, massive innovation. But it will take some more time for that growth, for that infrastructure now to be fully capitalized. And we can see this also when we look at overall e-commerce growth, not advertising, but just e-commerce spend. So here is the 2022 January forecast from Statista versus, based on the same historical data, our IAB Europe October 2022 forecast based on analysis of national markets and so forth. And there's a clear gap. Yes, we're going to see a massive rebound in 2024, but until that, there's 108 billion less available in e-commerce spend, in terms of spend or gross merchandise value, than we previously expected. So, with all of this, with these factors away from digital advertising, are we in an economically induced ad recession yet? Is it doom and gloom? Well, interestingly, we can see very, very different patterns. Look on the left here, where we've got the quarterly result of so-called big tech versus agencies. And you can interestingly see something that's remarkable. You can see a slowdown on the left, and you can see consistency of growth and even increase on the right. What's happening there? Yes, we see this e-commerce slowdown short-term. We see the short-term impacts of Apple's ATT. We also see that the SMEs are spending less. And on the agency still, we've got a very different client structure. We're seeing more upfront deals. We're seeing less frequent budget revisions in clients, so very, very different patterns. We are not in one single digital ad market which is exposed to economic challenges. We're in two markets, in two speeds at the very same time. And the headlines are very different. So it's not simple doom and gloom right now. Let's try to unpack the factors which are driving this. I think the first is we get very mixed signals from advertisers. Some sectors are spending heavily. Travel, for instance. We're seeing the beauty segment growing extremely fast. And particularly companies that are, in a sense, marketing driven, i.e. building brands. They are usually revising budgets drastically once a year and not cutting or upping frantically. Whereas sales-driven organizations focusing on really bottom of the funnel conversions, they are radically changing their budgets extremely quickly. And this is causing this kind of hot and cold sentiment that we're currently getting. I already showed you this divergence between different types of players. And also this e-commerce slowdown means that right now there is actually, or VC funding slowdown means that there's now a focus on profitability and not on growth by all means, which changes how advertising is supposed to be used. And we also currently actually see that the big bang in terms of the economic impact is only going to come still in Q1 2023, and it's currently predominantly structural events within advertising them itself that is slowing growth. And lastly, as a positive, we're seeing a lot of spend coming in from China into search, into social, etc., as the Chinese domestic market is suffering a severe crisis and Chinese sellers are pushing into Europe and in the US. Also why? Because finally shipping costs, container shipping costs, which were around $20,000 to ship a container from Shanghai to Antwerp a couple of months ago, have fallen to about $2,500. So this creates a massive potential for segments within e-commerce and therefore ad growth. So it's hot and cold at the same time. Regardless, we've revised downwards our forecasts for overall digital ad growth in 2022 and 2023, as you can see here. In May, I was also in Madrid presenting. I was still optimistic and predicted a 10.1% growth in digital ads. This I've now downward corrected to around 7% for 2022, and then a further slowdown in 2023. I think we're still going to grow in 2023. There's still more eyeballs, there's still change in advertising, but the non-digital part is going to decline, and then we're going to see a recovery in 2024. Now, all of this is the economic picture. What we're of course also seeing is that debate on privacy are radically altering how digital ads operate. What you see here, this tower with the wires, is the telecom tower in Stockholm at the beginning of the 20th century. And each of those single lines represents one telephone line to a household block. There were huge concerns, because when you picked up the phone, you could hear, if anyone else was on the line, you could hear what people were speaking in the entire housing block if someone was on the phone. And there was a magazine called American Electrician, the Wired magazine in a sense of the 19th century, which had this quote, which could have been said yesterday: "We shall soon be nothing but transparent heaps of jelly to one another." Meaning there's always been a tension between technological advancements and privacy. We've always been able to reconcile it in history, and I'm very optimistic that we can now as well. But we have to bear this in mind. So right now, today, when the cookies are going away, we're having this privacy debate again, and there will not be one replacement. In fact, the future will be based on several pillars. And I call these a spectrum of identifiability. Meaning on the very left here, you've got individuals, logged-in users, which you can identify one-on-one in a consented first-party way. And on the very right, you know nothing about the users. You just have contextual data, i.e., for instance, the editorial environment in which they're in, the weather, and so forth. In the middle, you've got all kind of different other approaches. And the future of ad targeting will be trying to figure out which combination of these things works, but the highest price is always on these logged-in users, ideally with email address, credit card, maybe transaction history, and so forth. But not all sectors can really benefit from this. So here we see, in terms of digital ad spend, the share that each sector has of digital ad spend in Europe. And I put some smileys next to each sectors. And that says, how ready is each of these sectors for a post-third-party cookie world? Specifically in the sense, how easy is it for a given sector to acquire and use first-party data, now the holy grail in this new world? And you can see huge differences. Typically, the closer an advertiser is to the point of consumer transaction, the easier it is to get first-party data. And you see some massive ad spending segments who just are removed from the consumer, who are partially driving blind, who need to rely on others, on intermediaries, on e-commerce stores and others to really figure out what those consumers are doing to build and then activate first-party data. And what you see here is Mr. Walter Ulbricht, a German GDR politician who said, no, we're never going to build a wall. And I think that was the same in the internet. We always said the internet was going to be open. But it's like, in a sense, we're seeing many Berlin Walls emerging right now in this world of first-party data, where we don't have one internet, but we have a splinternet, a fragmentation of the internet into closed ecosystems and walled gardens. If we count globally, there are more than 50 of those walled gardens, operating all with their own logic, their own attribution systems, their own data, etc. Meaning it's becoming increasingly harder to target, optimize, and reach consumers across these walled gardens, across these silos. But of course, this also opens up lots of opportunities. We know in a world after third-party cookies, tracking users across contexts is going to be much harder. So those that can build a full-stack solution in their walled garden, i.e. combining the delivery of an ad with the conversion event of a purchase, are going to be just fine and have an even stronger presence. And I think what's remarkable in here is that we see new players emerge. First of all, the open web, what we had outside of the big walled gardens, is also fragmenting with the different targeting approaches that I mentioned. But notably, look at the bottom here. We can see new players in here that we haven't had before, like Carrefour, a supermarket chain, in the business of selling bananas, not in the business of selling ads, suddenly has a walled garden because they have loyalty data, they have lots of consumers, they have spending history, and they have screen real estate in the app and on their web page. Why not turn into an ad network? And this means that in the context of these cyclical changes with the economy and the structural changes within advertising, targeting, there are going to be some new winners. And I think retail media is going to be just one of those winners, maybe the biggest, and it's a historical shift in advertising. And let's unpack this a little bit to see what the next couple of years are going to bring. So I showed you my forecast for digital ads. They didn't look too good. But now look at retail media. We see a systematic outperformance of the factor 3x, 3.4, 3.6x over total digital ad spend in the next couple of years. Reminder, retail media is ads shown on the websites and apps of retailers, typically for products that they do sell on those pages, and also buying ad space off-page using their own first-party data. This is going to grow because the macroeconomic headwinds are saying we need to be more accountable. Not growth at all cost, but sustainable growth based on real evidence data so that we know ad spend really affects the bottom line positively. And of course, the wonderful first-party data environment without cookies. All this is present in retail media. And many are saying, well, it's just Amazon, right? Amazon is a $31 billion ad behemoth. Well, yes and no. Because what we can see here, this is the European data. Yes, Amazon dominates this space. But we're seeing other players, so-called European endemics, come in. Carrefour, Douglas, supermarket chains like Rewe in Germany, Waitrose in the UK, Corte Inglés is coming into this space as well. And you can see those players are growing faster than Amazon, meaning the Amazon dominance is slowly going down. So this isn't, like search, for instance, a winner-takes-all market. We're seeing many different players having legitimate business in this, and they are endemic European players. And the markets are quite different. Amazon is heavily reliant, for instance, on Chinese sellers, on its own marketplace, where many of the brands moving into retail media are actually the big FMCG brands, the big brand advertisers who are pushing budgets in there. So it's not even fully competitive yet. And we can see it's big business if we just look at the US. So here are some self-proclaimed data. Not our forecasts, but actually what companies say themselves of how much money they currently make with and how much money they want to make with retail media. Walmart, biggest supermarket chain in the world, currently makes $2.1 billion with retail media, expecting to nearly double that by 2024. We see Instacart moving into this as well, already using self-serve ads like a Google, like a Meta, etc. Uber's moving into this space. They're not necessarily retail media in the sense, unless you think, of course, of Uber Eats. And the important thing here is they've realized that in a sense, if someone focuses on a screen, sees the car moving around, that's quality impression time, a quality time to actually deliver an ad. eBay is in that space, Target. Then we see the Europeans here, Carrefour and Zalando. Much smaller, of course, much more fragmented markets. But look at the long-term growth, and we can see they are turning into sizable business. Zalando expecting to hit around $1 billion of retail media sales by 2025. And we saw, of course, during the pandemic, a flurry of launches. So retail media has been around for some time. Like we saw, like, if we look at the back here in 2016, it was just, in a sense, ads on the retailer homepage. And now, of course, with more data available, with the e-commerce revolution and the pandemic pressure, we saw an explosion of launches just at the tail end of the pandemic. But how do we size this market? How can we really clarify this opportunity? Because many retailers don't publish any data about this at all. So we need to make some guesstimations. Right? We know the US data, we know data from Zalando, we know some data from company reports, and we found out there's a correlation between gross merchandise value, i.e. the volume of transactions on an e-commerce page, and the amount of retail media ad revenue that a retailer can generate. In the US, it's around 3 to 3.5% of online GMV that is now retail media revenue. We're a bit behind in Europe, maybe 3-4 years behind. So we can make some estimations here, conservative, likely, and aggressive, based on different shares of online GMV that retail media occupies. And I think it currently looks around like this, right? We've got a nascent and established and the leaders bucket in here. I removed Amazon from here, but you can see that the European players are clustered in the nascent bucket here. But for many, they have a target line. And this is this kind of purple spectrum here on the slides. That's the landing zone where they really want to get in 4 years. Meaning we can see retail media, or we can see kind of e-commerce growing slower than anticipated now, right? But we can see that retail media is growing faster than e-commerce in order to reach this share of higher online GMV. And it's already now an 8 billion euro market in Europe, including Amazon. But it's going to grow, even with the economic headwinds, in our view, to 25 billion by 2026. That's massive growth. Let's put this in perspective. So 7.9, roughly 8 billion now, 25 billion in 2026. This is right now as much as printed newspaper advertising in Europe. So it's not a small channel anymore, it's already huge. And in 2026, according to Group M data, if we remove AVOD and other data, it's going to be as big as linear television advertising. So this is not a small thing, it's a huge opportunity. Regardless, I think the real benchmark here is search, because both are crisis kids. Search really flourished during the previous financial crisis, Lehman Brothers collapse and so forth in 2008 and 2009. And it was retail media that was really born in the pandemic. So I put both at a year zero, right? Their year zero for search, it was 2008, and for retail media, 2020. If we look at those two different things, we can see how quick the growth of retail media actually is and how it actually accelerates over time. But for advertisers, crucially, it's not just about ad inventory. So we did some surveys among, in particular, FMCG buyers to understand what do you want to get out of retail media advertising. And yes, buying stuff, buying media is very important, but equally important is brand development and insights to actually connect the world of advertising and connect the world of product. And the same here, we can see here, to grow this, they say, what we really want is access to in-store e-commerce transaction data. That's what we really want to unlock. So I think what's happening here is something that's more important than just a new media channel. What you can see here is a typical e-commerce waterfall. What does it cost to kind of ship your product as a brand, and what's your margin at the very end? You see this ominous bucket in the middle here, SG&A, services, general and administration. Advertising is in there. In a post-third-party cookie world, you have massive signal loss, meaning the cost of reaching consumers across different platforms increases. However, if you can combine it all into a single platform or set of single platforms that combine ad exposure and conversion, you can really win, meaning you can actually increase your e-commerce margins. And that's why retail media is so important. It's not just about media, it's about commerce margins. And to conclude, I think we need to look at a very different market. What we can see here is not just advertising and marketing, but also shipment, fulfillment, and logistics. And I think increasingly, these are becoming convergent markets. In the past, in advertising, we just asked one question. On the left here, what does it cost for my message to reach or to elicit a desired consumer response? Right? We wanted to trigger a consumer perception change, action, and so forth. E-commerce had different questions. Well, how expensive is it actually to ship the parcel to the consumer? And now what we're seeing, what smart retailers are doing, they are targeting ads based on how cost efficient the delivery, the fulfillment actually is, i.e. you get a different price if you live closer to the distribution center. And these things are moving together. So it's really more about retail economics than media. The world of the CMO and the CFO are merging together. I mean, we have a globally massive market here in e-commerce. We see Alibaba, Amazon dominated, only one European player in the top 20, not much. But I think we have a huge potential. Although Europe is only 3.1% of global online gross merchandise value, we have many, many powerful retailers in Spain, in Germany, in France, in the UK, and so forth. And I think in particular, if we build alliances between these retailers, we can really thrive and succeed as a European continent and build something really powerful in the world of retail media and e-commerce. To conclude, not everybody can win in this world. We're seeing so many explosions of retail media networks coming right now. Everybody wants to launch their own. But can they all succeed and thrive? Well, here we can see as an example how the top 1,000 kind of retailers or e-commerce players are distributed in terms of revenue in Germany. A similar picture across other European markets. The top 10 make 40%, and then you've got a massive mid and the long tail. So you're only going to win in retail media if you're in these top 10 or if you're a category leader, for instance, in beauty and DIY in the middle. Otherwise, I think we're going to see the emergence of massive kind of Google-type kind of ad networks happening in retail media. But we need to make this market happen. It doesn't happen overnight. What you see here is the very kind of optimistic forecasts of someone else who said CNN Plus, the CNN streaming service, is going to grow tremendously in the next couple of years. And I don't want my forecasts to be as embarrassing as these, because just a month after these forecasts were published, CNN Plus was shutting down. Meaning there's work to do in retail media. We need to get better in attribution, in measurement, in fusing data across retailers together to really seize this 25 billion euro opportunity. And with that, thank you very much.
Daniel, thank you so much. Perfect. Thank you so much. Stick around, don't leave yet. We have a couple of minutes left. Would anyone here like to ask Daniel a question? Don't be shy. This is your chance.
There's one over there.
There's one over there? Fantastic.
Hi. Hello. Is it working? Yes? Okay.
Yeah, I can hear you.
Hi, Daniel. Thanks a lot. Okay, for especially all your projections and vision. As I'm a pioneer in the retail media industry, especially on the live shopping area, I would like to ask you about this new format. What's your perspective of live shopping, either in Europe and in the US? Of course, nothing to compare to Asia, but what's your perspective about that?
Yeah, I think it's a really interesting question. First, I think it ties a lot, as you say, into the whole retail media conversation, as we're seeing retailers acting agency-like and expanding their abilities to kind of live shopping or other services, social commerce, to really drive transactions. I think the beauty industry is really dominating this right now, but it's still fairly small in Europe and in the US. The real benchmark is China, where social commerce is already the default in a sense of doing e-commerce transactions. And a lot of that is happening live, in a kind of teleshopping 3.0 world. I think we are culturally different here, where it's not as natural. We didn't grow up with WeChat, and I think this is our huge problem in Europe, that it's going to be slower, the uptake. I think some Meta products, some TikTok products are really pushing this forward, but I think it takes more of a kind of cultural change for consumers to really trust buying from a moving image. And that requires, I think, education, safe payment solutions, but also some pioneers really doing it and retailers continuing to push it. I think it's a medium-term thing which could revolutionize how we buy things, but we need to be conscious that we can't copy China one-on-one in this market.
Thank you very much.